Hello and welcome, everyone. We'll go ahead and get started. There are a few more folks trickling in to the webinar, but it's about 12:01, so we'll kick it off here. Thank you for joining me today on the webinar on surviving a market crash in retirement. My name is Chris Hughes. I'm an advisor here with Monte Group. And just to manage your expectations a little bit, the presentation is about 30-35 minutes long, and my plan is to address questions at the end. But if questions come up during the webinar, there's a Q&A section, I believe, at the bottom of your screen where you can ask questions. And unless it's urgent, I'll hold off until the end to address the question. So with that housekeeping item out of the way, let's go ahead and get started. Today's webinar is a timely webinar, not necessarily because we're experiencing any sort of crash, because we're not. But the recent volatility that we've been experiencing over the last couple of months is a lot more than what we've experienced over the last couple of years. And it actually, caught some investors off guard. I like to think of it as a friendly reminder that stocks are in fact risky. So today I'm going to show you that a market crash or a bear market does not have to derail a sound retirement plan. And actually, if you plan for them and understand that they're a reality when investing in stocks, you're better equipped to both financially and arguably more importantly, emotionally deal with them. So I'll get started here. Just going to share my screen. So I've broken the presentation down into two parts. The first part is what you can do before a correction, a bear market, or a crash. In other words, what you can do now. And I'll use the terms correction, bear market, and crash interchangeably. They're all used to describe falling stock prices. If you were to define them, a correction is a 10% or more decline, a bear market is a 20% or more decline, and a crash I would define as a 50% decline or more. And the second part will focus on what you can do when we're experiencing a significant decline in stock prices. Like what to do when we're in the midst of a downturn. And honestly, it's not a matter of if, but a matter of when. And so by accepting the fact that the temporary market declines happen, I think you can be better prepared for them. And I'll show you actually how you can take advantage of the temporary declines. So we'll begin with what investors can do before a market crash. And it really, it simply starts with creating a plan and setting expectations. Most people look to the financial markets as their main investment avenue. And the good news, as you can see with this graph, is that the capital markets have rewarded long-term investors. So this illustrates the beneficial role that stocks play in creating real wealth over time. $1 invested in the S&P 500 in 1950 grew to over $1,500 through the end of last year, as you can see here with this gray line. $1 invested in the U.S. small cap index or smaller U.S. companies grew to over $6,300 through the end of last year, as represented by this green line. And $1 invested in the intermediate government bonds grew to $44. So you can see that each one of these indices beat or outperformed or outpaced inflation, represented by this teal line down here. Now, if you're just to look at this chart, you might be tempted to question why you'd have any money in bonds. Yes, it's outpaced inflation, but the returns pale in comparison to that of stocks, as you can see here with the gray S&P 500, $1,500, or small companies, $6,300. But what I'll show in a few slides is bonds show their value in times of market stress, and they actually act as a shock absorber when stocks fall. And that brings us to what I would consider the most critical part of an investment process, and that's selecting the right combination of stocks and bonds to hold that will maximize the chances that you meet whatever your long-term goals are. And this should really be tailored to your specific needs and your ability to tolerate risk. The previous slide showed a few of the building blocks of a diversified portfolio: U.S. large companies, U.S. small companies, and government bonds. And there are other asset classes within both stocks and bonds that should be included, such as international, emerging markets, and real estate. But selecting the mix between stocks, risk assets, and bonds, safer assets, is step number one. And here are 3 examples of how a retiree might allocate their retirement savings, from the most conservative on the left with 40% in stocks to the more moderately aggressive mix on the far right with 70% in stocks. The higher allocation to stocks, the higher future expected return, although it's a bumpier ride than, say, the conservative portfolio that only has 40% in stocks. But any one of these portfolios, these mixes, would be prudent for a retiree, but it's really important to select the one that's right for you. And I just want to revisit this slide just for 1 second. The issue with this graph is that it doesn't really illustrate the magnitude of short-term losses. This is a logarithmic scale, as you can see here by the y-axis. Otherwise, the stock market, the stock returns would be off the charts, and you wouldn't be able to see, the bond return or inflation would be barely noticeable. But as a result of it being a logarithmic scale, the dot-com crash that we experienced in the early 2000s, the great financial crisis that we had in 2008, 2009, they look like small bumps on the road, but we know that they were anything but. If you're going to invest in stocks, it's incredibly important that you understand historically what an investor has experienced. And most retirees will need to have some exposure to stocks to generate the growth that they need to fund what, in all likelihood, will be a long retirement that needs to keep up with inflation. So if you're going to invest in stocks, you darn well know how they've behaved. We've been the beneficiaries here of nearly a decade where stocks have risen pretty steadily since the bottom in March of 2009. And this recent correction that we've been experiencing over the last couple of months does remind us that stock declines are an inevitable part of investing. The good news, though, is that the corrections, the bear markets, and other challenging patches haven't lasted forever. So as you can see on this chart, the Dow, going back to 1900, has on average dipped at least 10% about once a year, and about 20% or more every 3 to 4 years. So while past results are not predictive of future results, we know that, each and every one of these downturns has been followed by a recovery and new market highs, every single one. So that's one of the key takeaways here. The declines are temporary, they don't last forever. Now, what's not shown on this chart here is a market crash or a decline of 50% or more. We all know about 08-09, where we experienced a 50% plus decline in stocks. The same for the dot-com crash in the early 2000s. So we had 2 50% crashes now in the last 20 years. They actually happen to be within 10 years of one another. But we've only had a total of 4 50% crashes in the last 90 years. The crash of 73, 74, and the Great Depression being the 2 before the dot-com and the Great Recession. So they don't happen as frequently as many investors think. But the garden variety of a 10% decline or a 20% decline are much more common. So I think that understanding this helps set expectations going forward. We don't know when temporary declines will show up. We don't know how deep they'll be. We don't know how long they'll last. But we know that they'll happen, and we know that they don't last forever. But so one way that investors can protect their portfolio against wild price swings in stocks is to have an allocation to bonds. I showed a few slides ago having somewhere between 30% to 60% in bonds is appropriate for a retiree and could really dampen the volatility brought on by stocks. Bonds act, like I said, as a shock absorber when stocks fall. So we know that bonds may not be able to match the growth potential of stocks, as I showed on that first graph, but they've often shown resilience in past market declines. So here are the past 4 equity corrections, decline of 10% or more, not including this year. And they happened in 2010, 2011, 2015, and again in 2016. The orange line in each one of these windows is the S&P 500. The blue line is the US bond index. In each case, US core bonds were flat or notched gains as the S&P 500 declined, providing that essential counterbalance in a diversified portfolio. So after the year that we had last year, where stocks went up every single month, they ended up somewhere between 20 and 25%, and bonds only delivered, a measly 3 to 4%. Investors are tempted to start chasing returns, moving money from things that have done poorly or haven't done very well to things that have done well, chasing performance. So we can get greedy. Investors can get greedy. And I'll tell you a story about a client who in late September reached out to us wanting to increase the amount that he had in stocks and reduce the amount he had in bonds. At that time, his stocks were up somewhere around 6%, and bonds had really done nothing for the year. So he was getting anxious with bonds not delivering much of any return. Fortunately, we convinced him to stick to his plan. Now we fast forward to today. Stocks are down about 11% since that call, and his bonds are up 1%. So very similar to what we saw during the last 4 market corrections. So there's 2 things here. One is just one of many examples where investor greed and fear can really negatively influence even the best laid financial plans. And 2, bonds are boring, and they're supposed to be boring, but they play a crucial role when stocks are out of favor, as we can see here and as we've seen over the last couple of months. So that's why it's really important to strike an appropriate balance for you between the 2 asset classes. So while the 2 previous slides highlighted the risk to stock investors in the short run, this graph shows that over longer periods of time, the overall stock market falls a little but rises a lot. This chart shows the bull and bear market since 1950. A bear market is defined by 20% more decline. A bull market is defined as a rebound off of that decline. So notice the downturns here, these little red shaded areas. They've been sharp but relatively brief, while these up markets, the blue shaded area, have been lengthy and rather generous. So this has been the pattern up until now, and there's really no reason to think that it won't continue. But it's these small red areas that have investors worried constantly, losing sleep over. What you can see here is that they represent such a short period in the grand scheme of things. And actually, if you zoomed in on this chart, you would see a ton of 5% declines, 10% plus declines. You zoom out to this multi-year time span, and most of those corrections turn into barely noticeable downward blips on, these upward trends. Think back to that previous slide where I showed the last 4 10% more declines since 2009. They barely register here and are actually embedded in this upward trend line since the great financial crisis. And I've circled the areas of where they are on the graph to show you that they're just small, they amount to small blips. And look at how the market has recovered from the downturns. And so that's kind of the takeaway here. And honestly, in our opinion, it's wrong. I don't know if wrong is the right word, but to be upset when stock markets decline, because instead of bemoaning the current decline, look at what happened right after. Significant increases. So this wraps up part 1 of the webinar, what you can do before a market crash. And it simply comes down to creating a plan that includes building an investment portfolio that you can stick with through thick and thin. And that means finding the right balance between stocks and bonds that is tailored to your personality, that will help you achieve, whatever goals that you have. And understand that stocks are risky in the short run, but that risk fades over time. The second part, I'll cover what investors should do when we're experiencing a decline in stock prices. And I just have 3 words for this slide: stay the course. Gosh, if I can't stress this enough. When the next big bear market comes, the last thing you want to do is panic and start selling out of your investments. If you do that, you're going to be selling low just to be buying in at higher prices. I can promise you that. I've seen it time and time again. Richard has seen it time and time again throughout his career as well. And so that's why it's important for retirement portfolios to be structured in a way to allow you to not only sleep at night, but avoid making costly financial mistakes such as panic selling at the bottom. And really a proper asset allocation, proper mix between stocks, bonds, and cash can help you stay the course through rough stock market environments. And I really want to emphasize the importance of resisting the impulse to panic sell. The key to corrections, crashes, bear markets is to not panic. Panic is what costs you money. And the impulse when stock markets fall hard for a few days, weeks, months in a row is to do something, anything. But unfortunately, that something is too often to sell to stop the pain of losses. And said another way, it's locking in permanent losses. So but what we know is that, in this past month is another example of it, is that these big up and down days in the market, they tend to be bunched together. Take yesterday, for example, when the market was up, the Dow was up over 600 points. So if you're trying to avoid big down days, know that you're likely going to miss big up days as well. And this chart illustrates the importance of staying invested in order to capture the equity premium. A hypothetical investment of $10,000 into an S&P 500 made in 1996 would have grown to nearly $44,000 by the end of 2016. But if an investor missed just the 30 best trading days during that 20-year time period, he or she would have ended up with just $9,000, less than the initial investment. So missing out on a few of the market's best days each year can have a significant impact on overall cumulative returns. And really, the bottom line is, if you sell in a rush to get out of a down market, you could, and in all likelihood, will end up missing some of the big gains when it ultimately corrects. And so a few days of strong returns can dramatically impact overall performance, as you can see with this chart. So just please resist the urge to panic sell. However, an even better approach than just sitting idle during market declines is to look for opportunities. And I wanted to share with you a real-life example of how we deal with volatility and temporary decline in stock prices in our client portfolios. There's no way to consistently time future market movements, so we don't even try. Honestly, it's a waste of time. Instead, we treat all temporary declines in price as potential buying opportunities. In other words, the exact opposite of what most investors' gut tells them. So here's the S&P 500 from July 2015 through the end of 2016. This was an 18-month stretch. For those with a short memory, which unfortunately are most investors, it was a roller coaster ride, especially the first half of this period. So starting here, in August of 2015, there was reports of slowing growth in China. Oil prices were cut in half due to slowing demand. That spilled over into 2016, where stocks got off to their worst start ever through the first 6 weeks of the year. Right here, this now amounts to just a blip on the radar, but this is what happened to stock prices immediately after the Brexit vote in the UK. This was a 2-day global stock market sell-off. I'm going to overlay this graph with red dots here showing times where there was activity in this client's portfolio to either buy more stocks that had gotten cheaper or carry out a tax management strategy where we were able to produce tax savings by capturing capital losses that could then be used to offset future gains and other income. So this is known as tax loss harvesting, and that's represented by the letters TL underneath the red dots. The red dots without the TL are the times that we bought more of depressed stocks. So what you'll notice here is we didn't catch the bottom on these buys, but catching the bottom wasn't our goal. And really that's only known in hindsight. Our goal is to take advantage of price declines, and that's exactly what we did. So by patiently buying low, we set this client up so that when investments eventually recover, and we know that they did, and they have always, the client isn't just even, but they're now ahead because he bought low. So this strategy it's called opportunistic balancing has shown to, on average, add about 0.75% per year to return. It's a big value add. Additionally, here are a couple of important figures that should be noted about this particular portfolio over this 18-month time period. We were able to harvest or realize about $60,000 of losses, creating a tax savings for the client. However, over the same time period, this portfolio actually appreciated in value, appreciated by about $50,000. So there was losses for tax purposes, but a gain overall. It was a win-win situation for the client. And additionally, those investments that we bought at a 10, 20% discount are up significantly since their 2015, 2016 lows. Think about how last year performed, and being able to buy when they were at their low point in 2016, we're now up 20, 25% just from last year. So the bottom line is these temporary declines, these bouts of volatility that are, they're to be embraced and to be taken advantage of when the opportunity presents themselves. I also have no doubt that this year will prove to be another year where patient investors were able to take advantage of temporary price declines and buy more stocks that were on sale. I'll wrap up by discussing what I would consider a top concern for retirees, and that is retiring at the quote-unquote wrong time, or the nightmare scenario of retiring right before a market crash. So of course, we don't know when these events will happen. They can't necessarily be anticipated in advance, but we can look at an example of someone retiring at what I would consider a less than optimal time, and see how their retirement savings held up during retirement. So I'm going to use March 2000. The significance of that month is that was the peak of the tech bubble. Besides maybe the Great Depression, it's hard to find a worse time to retire, right before two 50% market crashes that happened within 10 years of each other. So let's take a look at a retiree who retired at the peak of the market in 2000. This retiree has $1 million of retirement savings, and she starts by withdrawing 4% of her savings, or $40,000, and increases that each year by whatever inflation is. So the first year is $40,000. If inflation is 3%, the next year would be $41,200, and so on. So this first example here shows how a retiree would have fared had she invested in a U.S.-centric balanced portfolio consisting of 60% S&P 500, 40% 5-year Treasury bonds. This green line is the value of the retirement portfolio over this time period. The gray line represents net additions, or the remaining principal. It indicates how much this retiree has taken out during retirement. After about 18 years, you can see that the retiree would have withdrawn nearly all of her principal, about $900,000. However, the portfolio balance is actually higher than when she started. So this retiree would have survived two 50% crashes and still would have been okay. Next, we'll use the same example, but this time, instead of being invested in a US-centric portfolio, she's invested in a globally diversified portfolio. So it includes asset classes like the S&P 500, but it also includes US small companies, international large and small, emerging markets, and real estate. So this is a globally diversified portfolio, and this is very similar to the types of portfolios that we construct and build for our clients. The results, as you can see here, are dramatically different. Same withdrawals, but the ending balance is 2.5 times more than what she started. It's remarkable. So clearly, the globally diversified portfolio resulted in a much better outcome. However, let's just look at this green line, which was just the S&P 500 and the 5-year Treasury. Although inferior to the global strategy, if I were to tell you that you would experience two 50% crashes in US stocks in a 10-year time period, with one of those crashes happening right out of the gate, and then at the end of 18 years, you would have more than what you started with, after having withdrawn most of your principal. I'm sure most people would look at me like I'm crazy, but there it is. And the only reason that an investor who retired in March of 2000 started drawing 4% from their portfolio adjusted for inflation didn't see this outcome is if they panicked. And let's be honest, most investors did not capture these returns. It reminds me of one of Warren Buffett's famous quotes is that investing is simple but not easy. So this was certainly not an easy time to be an investor. However, even retiring at not a great time, you still can have an okay retirement experience. The two examples I used had 60% stocks, 40% bonds, but really any of the portfolio mixes that I showed earlier, from the conservative to the moderate, have fared well during this time period. And like I said, really the only reason that an investor would not have had a successful investment experience is he or she abandoned the long-term plan. So in the end, it comes down to focusing on what you can control. Create an investment plan that fits your needs and your ability to tolerate risk. Structure a portfolio along the dimensions of expected returns. I didn't really elaborate on this, but we know that in the long run, stocks outperform bonds. As I showed with that earlier graph, small company stocks outperform large. Stock companies that are considered value stocks outperform growth stocks. So we structure our portfolio to take advantage of those areas of the market that deliver higher expected returns. Mentioned being diversified globally and the importance of that. Manage your expenses, turnover, and taxes, and stay disciplined through market swings, market dips and swings. So, the rest is just noise there to distract you from your ultimate goal. The daily market news, commentary, economic predictions, recession forecasts, they just aren't all that important. What the Federal Reserve says or doesn't say should not impact your long-term plan. So I think, to have a better investment experience, investors should focus on the things that they can control, which really just boils down to the risks that they're taking, the cost, and their own behavior. So just to recap, the best way to survive a market crash, bear market, correction, or any other market decline and protect your investments from yourself is to have a plan that includes adequate diversification, not only between stocks and bonds, whatever's appropriate for you, your ability to take risk, but invest globally, the importance of that. And then have enough cash and bonds to cover 5 to 10 years worth of retirement draws. I showed earlier that these market declines are temporary in nature, every single one. So it's just a matter of having enough money and enough assets not tied to the stock market that can cover you during these bouts of market declines. And lastly, be patient and stick to the plan. This is not to say that the next downturn will be easy to endure, and I'm sure some of you feel like what we've been experiencing in the last couple months has not been easy. But if you understand that market declines are a reality when investing in stocks and you have a plan to deal with them when they come around, I think you'll be better prepared, and it doesn't have to upend your retirement plan. So with that wraps up my prepared remarks, if you will, and I'll open it up for questions. Let me pull up the Q&A. Feel free to type in questions in the Q&A box. I'll give a few minutes for those folks to ask any questions that you'd like. Here's one that just came in. So now, let's see here. So now that the market is down about 10% from its all-time high, should I wait to reposition my portfolio? So that's a good question. So we're about, depending on where we're at today, anywhere from 6 to 10% down from the all-time highs. So we're right around that correction territory. I believe we hit it last Tuesday. But the answer is no. I don't think you should wait for stocks to recover. The 10% decline could easily turn into a 20, could easily turn into a 30%. So I think the best way to look at it is, the decline in stocks that we've seen over the last month or so has erased 2018's gains. But if you look at it over a more multi-year level, we're still up pretty considerable. The stock market's still up pretty considerably over the last few years. So I think instead of looking at it as a snapshot of, well, stocks are down over these last 2 months, maybe I should wait. I think it's important to reassess whether or not you're taking on too much risk for your own ability, and adjust the portfolio as necessary if needed. Another question here is, when rebalancing or buying low, as you explained, what are you selling, or do you just referring to folks who have cash? So great question. So some clients have cash in their portfolio, which we use and we deploy and we buy more stocks that are down. For those who don't have cash just sitting in their account, as I showed earlier, when stocks go down, there are other asset classes that either hold their value or appreciate in value, like I showed with bonds. Another asset class is gold. In times of market stress or panic, people tend to flock towards things what they view as safe. So when we're experiencing those decline in stock prices, we use other assets. If there's not cash available, we use other assets that have either held their value or appreciated, trimming off some of the gains and putting it into things that have gone down in value. So that's one of the ways that we take advantage of it, is that if there's not cash available within the portfolio, then we look to other assets that have actually held their value during the rocky time. It's a great question. Looks like that might be it. If anybody has any questions, feel free to reach out directly to me or anyone on our team. We're happy to help. I appreciate everyone for joining me this afternoon. I hope everyone enjoys the rest of the holiday season. And until next time, take care.